Welcome back to Learn SKN, and today we're going to continue looking at the January 2018 paper 2 for Principles of Business. And so the last video we looked at number 3, and so naturally we're going to continue with number 4. So we're going to roll right along into number 4. And so number 4, the first question asks, number 4A, define each of the following terms. And so you have investment and you have savings, and both are 2 marks each. And so we're going to define investment and define savings. And so we're going to go to the textbook, and so we have a nice key section here that shows the definitions. And so we have savings, the part of an income that is not spent. So your savings will be that part of your income that you don't spend, that part of your income that you put away. So you put it away either in a bank account or somewhere else, not to be used. So that's your savings, the part of your income that you do not spend. I do not consume, you put it away, you save that. And then we have investment, the purchase of assets in order that these assets will earn future income for you. So that's the whole thing about investment. You do it today to earn future income for you. So that's the 2 definitions we can work with there, 2 marks each. So savings, the part of your income that is not spent, and investment, the purchase of assets in order that these assets will earn future income. And it's just like that, you would gain 4 marks for that question. So investment and savings. Then number 4, part B. So this number 4 is taken from the finance section of the syllabus, the finance, business finance. And so number 4B, identify 2 sources of capital in each of the following markets. And so CSEC trying to get all tricky here with you. So instead of saying short-term financing and long-term financing, they choose to say money market and capital market, right? So the money market is the same as short-term financing, and the capital market is the same as long-term financing. That's what you would see in the textbook. You'll see short-term financing and long-term financing. And so we have a whole lot of examples here of both short-term and long-term financing. And so the short-term or the money market would include things like a bank overdraft. Then you also have examples such as a loan, whether from a family or from a short-term loan from a bank. So loans, short-term loans, those are examples of, money market sources of finance. Then of course you have retained profits from the company. The company makes some money and you use some of the profits to pump back into the business. Then you have bill of exchange. That's the next way of short-term financing. Then you have trade credit. You have promissory notes. What else do we have here in this table here? We have installment credit, indigenous credit, private money lenders. All those advances from the customers, all those are examples of short-term or money market financing. So sources of capital from the money market, short-term, and we have a whole list right there. And so we have you have more examples here. Bank loans, as I said, overdrafts, supplier credit. Those are examples of money market financing. Then you have the long-term or the capital market financing, source of finance. And so you have more long-term bank loans, over a year, 2-3 years. You have mortgages, you have bonds, you have shares, you have venture capitalists, people investing in the company now for later rewards, development banks, government agency, and you have soft loans. So all those are examples of capital market financing. Right here, the capital market, source of finance. And so you have the more long-term, so shares in the stock market, debentures, you have bonds, treasury bills, venture capitalists, hire purchase, angel investors, leasing. All right, so those are examples of long-term financing. All right, minus the treasury bills thing. No, that's not long-term financing for companies like that. That's more when you as a person want to invest for those kind of things. But yeah, for source of finance, all these: leasing, hire purchase, angel investors, venture capital, crowdfunding, government loans and grants, more long-term, over a year. You have bonds and debentures and those kind of things. So all those are long-term types of financing. And so if you just, all it says identify, 2 marks each. So you identify 2 from the money market, two from the capital market, or two from short-term financing, two from long-term financing, as in the capital market, and you're good to go. And that's how you would get your answers correct for that one. And then we're here at question 4, part C. State two factors which could determine how much capital a firm borrows. So what can determine how much money or capital the firm borrows? And so of course you have things like, how long the money is needed. So if the firm needs a lot of money for a long period of time, of course they might borrow more to last them a longer period of time. But if they need it for like a quick turnaround or something like that, short-term financing, then they would borrow less because it's something they need just in the short term. So how much they borrow can be influenced by how long they want the money is needed. If it's for a long period of time, then of course they will go for more long-term financing, and so they can draw down over time when the needs arises. But if it's a quick turnaround, a quick short thing, then they will go for less amount of money in a short term, and so that can help to determine how much they borrow, how long the money is needed. Of course, how much it will cost, because borrowing is not free. Borrowing is not free. So if they know that the cost of borrowing is high, meaning that the interest rate, the amount you have to pay back is high, then you might go and borrow less. But if the money is basically being given away cheap, interest rate, maybe 2%, maybe 0%, whatever, then you might borrow more because the payback is less, and so you would be incentivized to borrow more based on how much it actually costs to borrow that money. So if the interest rate is high, you might borrow less. If the interest rate is low, you might borrow more. Then let's say whether you are willing to give up a share of company ownership to obtain additional financing. And so you have to measure now how much you need, and if how much you need can really measure up against giving up part ownership of your company. So if you need a lot of money and the only way you can get that money is from some selling shares and things like that, then of course you might be willing to give up that for a lot more money. But if you only want a little bit of money, then you might not be willing to give up your shares for that reason. But the two main things to focus on here is the cost of borrowing and how long the money is needed for. If the cost of borrowing is low, you borrow more. If it is high, you borrow less. If you need money for a more long term, then you borrow more. You need money for a short term quick turnaround, then you borrow less. So all those are reasons that you can use to say how much a firm might borrow. All right, so that's C. Then you have D. Describe two methods used by central banks to regulate the activities of commercial banks. And so we know that the central bank is basically the banker's bank. They are the bank of last resort. They are the bank that overlooks the monetary policy for a given country. They are a creature of the government for that country. But they also are in charge of regulating the financial sector for a given economy. And so ways in which they can use their power to regulate activities of the commercial bank includes things like, of course, issuing license, because they are the ones that issue license to various banks. And so if they don't issue a license to you, then that means you cannot operate as a bank. You're not able to operate if you do not get a license from the central bank. No one can operate commercial bank without first acquiring a license from the central bank. So they can use that to basically regulate how the amount of commercial banks that are able to operate within an economy. Also, changing the minimum reserve requirement. So the question is asking for you to describe two methods. And so when I say changing the minimum requirement, the minimum reserve requirement, by law, commercial banks are required to hold a proportion of their total deposits in cash in the accounts at the central bank. So by law, the central bank can tell the commercial bank, okay, you have to keep X amount of your deposits at the central bank, so you don't have access to it right away. So for example, if a bank has customer deposits of 100 million and the central bank sets a minimum reserve requirement of 10%, then the bank must keep 10 million worth of cash at the central bank. This is how they regulate now. this will reduce the amount of money the bank can lend to its customers by 10 million. So what they're saying here is that by increasing or decreasing this reserve requirement ratio, a central bank is able to influence the amount banks are able to lend to their customers, and therefore total spending on goods and services in the economy. So this whole thing is this is just the point right here. They can control the minimum reserve requirements, the amount of money that a commercial bank has to leave with the central bank. And so by doing so, they can alter the amount of money that a commercial bank has to lend to its customers. So if they increase the reserve requirement ratio, then the commercial bank has less money to lend. If they decrease the reserve requirement ratio, then the commercial bank has more money to lend to the customers. So that's a way of regulating how much loans the commercial banks can let out based on the reserve requirement ratio, or the change in the minimum requirement that the central bank has for the commercial bank. Also, varying the liquid asset ratio, similar to above, but commercial central banks also require commercial banks to maintain a certain percentage of their total deposits in liquid form. So liquid means that it's easily converted to cash. So what they're saying is that the central bank can tell the commercial bank how much money, how much of the assets should be liquid, how much cash they should keep on hand. So that means that that could keep the cash flow going on a day-to-day basis. So they don't want a bank to have a lot of assets and most of it is not in liquid form. They're not easily converted to cash, because they might have problems if people come and want to withdraw their money. They might not have enough cash on hand to give the customers. So the central bank say, look, you have to keep this amount of liquid cash on hand at all time, and that again would alter how much money they have to lend in terms of loans. So that's another way of controlling the commercial bank or regulating the commercial bank. Another way is varying or adjusting the bank rate. Now, what is the bank rate exactly? So remember, I said that the central bank is the banker's bank. So that's the commercial bank's bank. So if the commercial bank runs out of cash, they would borrow that money from the central bank. And depending on the interest rate that the central bank charges the commercial bank, that can determine how much money the commercial bank can borrow and how much money they would have on hand, and also what interest they would charge the customers. And so if the central bank gives them a high interest rate for borrowing money from them, then of course the commercial bank would pass that on to the customers, a high interest rate loan, and so therefore that can reduce the amount of people who come to borrow. So the central bank can use it to control the money in the economy also, but also control the commercial banks as to what interest rate they can charge for their loans to their customers. So that's another way in which the central bank can control or regulate the commercial banks. It can regulate how much interest rate they can charge on their loans based on how much they in turn charge the commercial bank for borrowing from them, the central bank. So all those are ways in which the central bank can control or regulate the activities of the commercial bank. So you choose any two, you describe them, and you get your 4 marks. So the last one for number 4 on the January 2018 paper 2 for principles of business is E. Explain one benefit and one risk of using the stock market for investment. One benefit and one risk of using the stock market for investment. And so we know that the stock market is all about risk and reward. It can be highly risky, but the gains can be, of course, very rewarding. So, but buying and selling of shares is done on the stock market. Not all companies can go on the stock market. And so in a nutshell, at a glance, some of the risk involved and the benefits. So the benefits, shareholders receive dividends from the profits. So when you invest in the stock market, you own a piece of the company. And so if the company does well, and they make good enough profits and they decide to pay out dividends, you can have that annually. So if the company keeps growing, keeps doing well, making profits, you can have a passive stream of income almost on a regular annually. So if the company does extremely well, share prices go way up, then your dividends should go up. That's a benefit right there. You can have passive income over time, and the share prices can go up. You can also gain if the share price increase. You can sell. So you can buy, let's say you buy them for 50, and then the share goes up for 100, you sell higher than you bought. And so that's one of the key things about stock exchanges. Your aim is to try your best to buy when it's low and sell when it's high. So you can gain a lot of money if your gains can be high if you sell when the shares are higher than when you bought them. Shares can be used as collateral for loans. And so you can say you're going for a loan, you can say, okay, I have X amount of shares in this company, and the bank can use that as a way of securing a loan. So those are benefits you can gain from investing in the stock market. So you own a part of the company, and as such you get dividends. If the profits go up, you get more dividends. So that's a passive stream of income. You don't have to even work for that, and you get that annually or quarterly whenever they pay dividends. You can buy low, sell high, and the difference, you can have a capital gains, as in you increase the amount of money you gain by the margin that you bought and sold for. And of course, shares can be used as collateral. But some of the risk involved: if the company doesn't make a profit, you don't get any dividend. If the share price start to fall, then you lose, because you might end up selling for lower than you bought. If the company is in trouble, then the bank might not be willing to take that share as collateral. And of course, if the company goes down, goes under, the shares equal zero, and so you have basically garbage in your hand. You have nothing. That's a risk, because companies, as the stock market is so fickle, that one set of bad news for a company can send the stock prices just plummeting. And so you're at risk for that happening, at risk of losing everything. A lot of people invest in the stock market, company goes under, you lose retirement, you lose everything. Another advantage of our benefit of investing in the stock market is that the stock market tend to be better. The rewards are higher than just plain old savings, right? In the long term, it tends to outdo any savings scheme that any bank could have. So it has an advantage over savings, of course. So all those are advantages, benefits, and of course the risk in using the stock market. And so the book has it outlined again, nicely outlined in the textbook, where you can read and go more in depth with this one. They say one difference between saving and investment is that investments are more riskier than savings, and we said that. Now, in the stock market, as it relates to the stock market, as we said before, we said it's about the buying and selling of shares, and so you become part owner. And so the trick is to buy at a low price and sell at a high price, and that way you gain some monies from that. But again, risk is involved. High risk, high reward, but risk involved nonetheless. They say in the long term, most stock markets produce better returns than bank savings, right? So that's another advantage right there. But the risk in investing in the stock market is, like I said, it's very fickle, and the least thing can cause a collapse in the price of stocks. Like when you're looking at Amazon and Google and Apple, when you see the quarterly report comes out and you see that the company did not meet its expected revenue, the stocks start tumbling. When you hear a CEO like Elon Musk doing something crazy, or Jeff Bezos getting in trouble, the stock price start to crumble. And so the stock market is very fickle, very susceptible to shocks. And so it can crumble, it can go to zero. Like they have an example here. For example, one of the world's largest toy shops, Toys R Us, went bankrupt in 2018, and around 800 stores were closed. Shares which were once bought and sold for $45 each suddenly became worthless, right? So with anything, risk, reward, so you have to know which one you are looking at when you're looking at the stock market. Yes, it has its advantages, and it has disadvantages. The risk can be great, but so can the reward, and so you have to measure those things. All right, so if you explain those two factors, explain one benefit, one risk, you would gain your 6 marks, and that would be it for question 4 for the 2018 POB paper 2 for number 4. So that would be it. All right, so again, go back to the previous videos to get number 1, 2, and 3. This is number 4, and so we have one more to do for this paper. That would be number 5. So the only way you can find out when number 5 has, the video for number 5 has dropped, is of course by subscribing to this channel. And coming later on, stay tuned for the July 2020 multiple choice paper. So that's the multiple choice paper from last year, June, July, August exam. So I'm going to drop that soon, but the only way you're going to know if I drop that is by subscribing and hitting the notification bell so you know when the video drops. All right, so that's it for now. Thanks for watching. Thanks for listening.